Hi, today I would be talking about the Indian financial sector. Clearly, last one quarter has been a very challenging quarter for the Indian financial sector because of an unprecedented event like demonetization. Post demonetization, what we have seen is that the banking sector credit growth has fallen down to as low as 5%, which is a multi-decadal low. Clearly, net interest margins and asset quality have also been hit for most banks and NBFCs. However, with the measures taken by the government and the Reserve Bank of India, clearly the normalcy is restoring sooner than later, and to that extent we believe the impact of demonetization is likely to be more transient rather than more permanent in nature. Post the demonetization drive, the budget presented by the Finance Ministry has been more pragmatic, unlike the popular consensus where the budget would be more populist and the government would spend very heavily. Clearly, the government has contained its spending and the fiscal deficit continues to remain fairly contained. One of the major developments post demonetization and budget has been the monetary policy, where the Reserve Bank of India has changed its stance from accommodative to neutral. Clearly, post that we have seen bond yields hardening in a significant manner, and clearly we believe that interest rates are likely to start moving north post the RBI policy. What we saw in the Q3 results, clearly growth, asset quality as well as margins have taken a hit. Nevertheless, we expect going forward the credit growth to pick up to almost 10% at the industry level, and individually at the bank level also the numbers to improve. Margins and asset quality is likely to remain under pressure. Nevertheless, asset quality is something which we would be monitoring very closely in terms of development. Large NPL resolution will be key for asset quality for some of the large private as well as PSU banks. We believe going forward private banks will continue to gain market share, whereas for PSU banks, with bond yields reversing, trading gains could reverse. For NBFCs, the cost of funding could be under pressure, and to that extent there could be some pressure in their net interest margins.